Hey guys, so now that we've talked about government failure being how the government intervention can lead to an inefficient allocation of resources so that opportunity costs are not minimized and that living standards are not maximized, we can talk about more in depth of how indirect taxes can lead to an inefficient allocation of resources. So what are indirect taxes first of all? So indirect taxes are payments made to the government following the consumption or production of certain goods or services. Okay, so what this means is that the government requires certain producers or consumers to actually pay money to consume or produce a certain good or service, and this helps eliminate the overproduction of undesirable goods. Just call that G. Goods. And so let's look at the example of the market for cigarettes. And as we all know, cigarettes are a highly undesirable good to produce because it causes pollution and it causes secondhand smokes, which can damage the health of third parties not involved in the transaction. And so what the government does is the government adds an indirect tax on cigarettes to reduce the quantity consumed in the economy. So applying this to simple demand-supply analysis, we have the quantity, the production, relatively upward sloping supply curve, and again a downward sloping demand curve. Now we can see that prior to any changes in tax laws, we see the equilibrium quantity produced at P1 and an equilibrium quantity produced at Q1. And as we can see here, the producer surplus is here below the price and above what they could supply at, and the consumer surplus here above the price which they buy for and below what they value cigarettes at. Alright, so what happens is when they increase or when they add a tax to it, let's just assume that a packet of cigarettes here is actually $5. And what happens is when they add a $5 tax, so let's say they add a $10 tax to cigarettes, what happens is that the new price is at $10 or $15 to make it more realistic. $15. Let's say the tax is instead, let's keep it at 10. Let's keep the tax at $10, but let's increase the equilibrium quantity or equilibrium price of a cigarette to $10. Okay, this is a more realistic example. And so now we can see that this is what the buyers buy cigarettes at, and at the supply point here, it's actually what the sellers sell cigarettes at, which is only $5. So now we can see that at $5, because producers are not maximizing profits, or they don't allocate their resources efficiently so that profits are maximized by allocating resources to the production of cigarettes, we can see they would only produce a quantity at Q2. So what this means, we can separate these triangles into different areas. So let's call this area A. Let's use white to make it more visible. A, B, C, D, E, and F. So as you can see, before we have introduced an indirect tax on cigarettes, the consumer surplus, or CS, is A, B, and C. So we have A plus B plus C. And the producer surplus was at D, E, and F. So D plus E plus F. And the government revenue is 0 because they haven't charged any taxes, so they haven't gotten any revenue from that. So the total surplus will be A plus B plus C plus D plus E plus F. So we can see at this point here, a lot of people in the economy are happy and the market has reached an equilibrium at Q1 and $10. But now that since the government has applied tax or put an indirect tax on cigarettes, we can see that only people who value cigarettes above $15 would actually buy it. And this represents a consumer surplus of only A. And so the change here would actually be negative B minus C. And only producers who can supply cigarettes at less than $5 would be willing to produce. Because since the cost-benefit analysis suggests that marginal benefit has to exceed marginal cost for production to occur. So let's say if producers supply at $7.50, but now they can only make $5 revenue from it. $5, so they make a loss of $2.50. So obviously, producers who can only supply cigarettes at $7.50 wouldn't be able to produce because they are incurring a loss here. So before this tax was introduced, they could, because they could sell the cigarettes in the market for $10 instead of $5 and produce a $7.50, and so they make a $2.50 profit, and so that they would enter the market. But now, since the price they're selling at is only $5 because of the indirect tax of $10, they are not willing to supply, and so only producers who can supply at less than $5 would supply, and therefore this results in a quantity of Q2 being supplied in the market. And so the producer surplus with tax is only F, and so we can see the change is negative D minus E, so this area here. And so the government revenue would just be the taxation that they receive from every purchase of cigarettes. So the buyers buy for $15 and the sellers only earn $5 in revenue. And so this means the $10 in tax would be given to the government. So this is a form of 15 minus 5 times the quantity. And you can see that this would represent the area of B plus D. So the change would be B plus D. And now if we add these up, you have the total with tax surplus is A plus B plus D plus F. And now if you add this up, the change would be negative C minus E. And what this represents here is the dead weight loss, or the allocative inefficiency in this market. And although we've seen that the government has introduced this tax so as to reduce or eliminate the overproduction of cigarettes, they've actually incurred a dead weight loss here, because some people still derive pleasure from smoking. And because now the price of cigarettes are $15, some people aren't able to purchase cigarettes anymore. And at the same time, some suppliers who derive profits or make a living from selling cigarettes aren't able to supply it anymore, because the profits or the revenue derived from selling cigarettes is now only $5 after the indirect tax. And as you can see, this is another form of government failure. And even though the government has aimed to increase the overall material or non-material living standards of the people by reducing the overproduction of undesirable goods, they have in fact caused an inefficiency or an inefficacy in the market by creating a dead weight loss of negative C minus E, and this is an inefficacy in the market.